Welcome to this MMF session for October. As you know that this multi-millionaire forum, and for all the people who are listening to this for the first time, this is a knowledge sharing platform. It's purely educational. We don't talk about any particular investment or service. We just pick up a subject and then we have a little discussion. First, we put forth before you some research that we've done and the revelations that we had from this research, and then we have a Q&A session. So that's basically what we do every month, Saturday, 11 a.m. All right. So please do join for the future events. All right, let's move. So this time we are going to talk about global interest rates and their movements and why they happen, what happens as a result of these movements, what to expect, and in the next couple of years, there's something new which is going to happen. Of course, it's going to be a new cycle, a completely new economic cycle. So global interest rates, basically, the interest rate that you see, the Fed rate in the US and the repo rate and the CRR and the RBI reference rate and all that we have in India. And similarly, Bank of England rates and Bank of Japan rates. So these are all regulators around the world who are continuously moving the rates up and down based on economic scenarios. But let's basically, on a very, 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 very basic level, let's just sort of understand how these interest rates move and why these interest rate movements are necessary. I mean, this is purely academic and for the information of all the people who didn't know. So what we'll do is we're just going to start from the place where you see this green arrow. Okay, this is just one little demonstration that we wanted to show you. So, and this is of course in reference to RBI, but pretty much the same thing for Bank of Japan or Fed or anybody else. So RBI increases a rate. Let's just start from that as a premise. So why are they increasing the rate? Because what is happening is there's too much of money flowing in the system. So it's just like this. Think about it this way, that you're giving some pocket money to your kid. And then you're figuring out that you thought that the kid needed more money. There was inflation. So you were giving 10,000 every month, but 10,000 wasn't enough. And so you start giving 12,000. That's not enough. You start giving 14,000, not enough. You start giving 18 or 20,000 to your kid. Now, what happens is some point of time you realize, the kid has got a lot of money. And what is happening is there's too much of money and the kid is not being able to use everything out of this money. So you feel, let me grab this money back a little bit. So then what the RBI does is it raises interest rates. Now, when the interest rate is raised, very simple. If the bank offered you, say, 6% fixed deposit, and then by the raising of rates, the fixed deposit went to 7% or say 8% or 9%, a lot of people would be motivated to go back into the bank, right? So what then happens is when rates go up, inflation reduces because too much of money was moving in the system. They want to suck the money out of the system, okay? And what happens is inflation reduces. So can you go to that? Can you, as I speak, can you just sort of mark on the cycle here? Can I see your cursor? Yeah, very nice. So the first step is over. We are pulling out the money. We are getting higher returns on savings. What happens after that is inflation reduces, okay? Lesser money is there in the system. Now, this continues for some time. Now, what happens if RBI takes away all the money, the central bank takes away a lot of money, then automatically people have less money in their hands. The kid will have lesser money. If the kid has lesser money, not able to spend. But when you think about it from a country's point of view, if we had lesser money in our pockets, we would not be able to buy new factories, new plant and machinery, and which is why it says the economic growth slows down. Now, when that happens, that becomes a time to say, now let us reduce the rates, okay? So then RBI decides, there is too much of slowdown happening, so recession happening, let me sort of reduce the rates down. Okay, the moment you reduce the rate, the first guys who get angry and who get hassled are the people who are investing in fixed deposits, because what happens is they get lesser return on their investment. But at the same time, all the people who borrowed money start celebrating because the moment rates come down, your loans become cheaper. Okay. Now that happens. After that, there is more money circulating. So this is akin to a situation where you are giving more money to your kid. More spending, That means there's going to be more goods and services on which we are going to spend money. And basic economics plays in. So if there is this pen to be sold by the shopkeeper, and if there are 100 people who want to buy, he's got enough supply. But suddenly, if there are 500 people who want to buy the same pen, he will think, why don't I sell it a little higher? He starts increasing the prices because there's a lot of money chasing, there's a lot of demand for this pen. And as a result of which, the interest rate therefore comes to a level where RBI says, oh, there's too much of action happening, too much of money, floating around the system. Let me pull the rates, let me increase the rates again. And that's basically what happens. Okay. So can you just put the presentation off? So friends, the point is, this was a bit of a difficult concept to understand, but the essence of this concept is there are times when the rates go up and there are times when the rates come down. This is something which happens constantly and continuously. So there is never going to be a time where you will see that the rates are steady. There's always some action happening, but there are in between times where things are steady. Things are just absolutely steady. Nothing is happening. Let's move to the next point. All right, okay. So that was the basic, okay? Now let's go a little deeper. When interest rate rises, one of the first things that should happen logically, let's think about it, when they rise. So depositors are happy because they are going to earn more. Borrowers are not going to be happy because if we have a home loan running and if the rates go higher, we have to pay more, which means, but actually we don't actually pay more. The EMI remains the same, but because of the rates going up, what happens is the interest cost goes up and the principal repaid every month in that installment of monthly EMI is lesser and lesser. So the number of months that we have to pay the loan still, they start jumping upwards. They start moving further up. So instead of 12 years, you have to go to 15 years and 18 years. These kind of horrible things happen. And, for example, especially in America, and people who are from America and people who have friends and relatives in America will very much relate to that. In the last few years, and we'll show what happened. When the rates were going up, people were having a very, very hard time because suddenly with rates going up, inflation happens. And with inflation happening, what automatically starts happening is that, people's spending power decreases, things become expensive. They can just about manage. So America went through a very difficult time. So did Canada. So did Europe. We'll talk about all of that. But basically, rising interest rates are essentially not good for anybody because they're only good for depositors because you feel a little good. But they also don't realize that their purchasing power is reducing because higher rate means higher inflation. Okay? Next. So in the same fashion, when rates go down, the best thing that happens from an individual to us is our borrowings become cheaper. So the number of months left for our housing loan, for example, I'm using housing loan as an example because most people can relate to that. So the number of months left on our housing loan, they will start reducing, they will start crashing. So lower borrowing costs, lower rates always are a happy moment. Depositors don't earn so much, but the smarter ones who invest in gilt securities, they make a lot of money. We'll talk about that also in a bit. So the moment interest rates go down, obviously what happens is from a company point of view, their profits go up. And their profit go up means obviously, what is supposed to happen is profit going up because money is saved on interest payments. Profit goes up means there's more profit, share price goes up and everybody makes money. And then there is a rally in the stock market. So that starts happening when interest rates sort of start falling. Okay. Now, let's look at what happened in the last few years. Can you take us there next step? Yeah. So this is very interesting. Okay. We've taken out some examples exactly of the last 5 years. So in 2018, the world was going through a phase of very low economic activity. And as a result of which, it started from America, the Fed lowered rates, as you can see in 2019. And this was to spur growth. So when you reduce interest rates, so see, there's also another logic that plays. Okay. There's another very interesting logic that plays. And Okay, just one second. There's a very interesting logic that plays out here. And that logic is that when the interest rates go down, when the central bank reduces the rates, see what happens is all the banks have to park lesser money with the central bank. So you're aware of this, that when the rates go up, banks have to reduce their fund size, they have to stop their lending, and they have to park more money with the RBI or the central bank. And in the same fashion, when the central bank reduces the rates, banks have to park lesser. Banks will have more cash in hand. So they can lend more. And because they can lend more, people have different ways of using the money. Some people will put the money into industry and factories and land and building, plant machinery, working capital. And some people, what they will do is they might even invest in the stock market and the bond market, which is why you see that as soon as the interest rates go down, banks are flush with funds and economic activity starts happening. So now put that slide back, please. Okay, so what is happening here now is that in the pandemic, what happened is now suddenly it was a very unique event, once in a 100-year event. So what happened is interest rates were anyways, they had started reducing interest rates from 2019. Okay, and in 2020, because the economic activity was literally not there, because everybody, all of us, we were sitting in our houses. It was a lockdown around the world. So economic activity actually went sub-zero. I mean, near zero, right? Government, they didn't have an option. They started cutting down the rates to almost zero. We'll just show you that in a minute. Okay, but what happened as a result of that is, of course, everybody had more money because they were trying to say that, well, from your homes, do some activity, and let some money circulate. But obviously, what happened is, because in America, the government actually printed money, put money into their bank accounts. So people started becoming rich. And what we saw is that people didn't have any activity to do. So around the world, everybody, whoever had money, started investing in the stock market. And we saw the crash of COVID. And in no time, all the exports of the world suddenly went wrong, and the market started shooting off, and a huge rally started happening from about May and June of 2020, right? So we saw that. Now, okay, what happened after that? The story goes on. So when there was so much of money, stock market, everybody was making money. But then the moment the lockdown was released and everybody came back into the working mode and into industry, what suddenly happened is there was just way too much money, and the inflation skyrocketed because there was too much money chasing those goods and services. Now, Fed did not have a choice but to start raising the rates. And when they started raising the rates, okay, that was absolutely crazy. They went from near zero to 5.25, 5.5%. And somewhere in the middle, they went as high as 9.1 in June of 22. That's what the data shows. Now, that is what actually crippled the entire American economy, European economy, and then don't forget, in between, there was this Russia and Ukraine war that also started. So what started happening is everyone's budget just went for a complete mess. I mean, people were just not able to make ends meet. They were just, and you see, the EMI remained the same, but in some cases, the EMI was just about enough to cover the interest, or not enough to cover even the interest. Forget principal repayment. From a housing loan point of view, other loans point of view. So the EMIs also started rising. It just started eating up in everybody's budgets, and everything went haywire. Then, after that sort of a period, they had to raise rates. They had to really, suck the money out of the market, out of the system. And then now we are somewhere at a point where inflation, federal rate in America and the US Fed says now that now the inflation is a little bit in control, and therefore economic activity needs to be kick-started again. And that's why the first rate cut that happened on September 18. So do you see how the picture moves, and how interest rates go up and come down, and what happens to economic activities? This is a very nice, I mean, the last 5 years have been brilliant in terms of the activity, and it was actually almost by the book. I mean, absolutely textbook movements of interest rates up and down to combat economic activity, to combat inflation and ensuing recession, etc. So it just worked perfectly by the book. Let's move forward. Now here's what we're going to show you, something very interesting. Can you change your screen? Now watch this very carefully. This is very, very interesting, okay? Yeah. So now, can you sort of, this is last 20 years, right? Let me just start my annotations also. Just 1 second. Yeah, okay, I got it. Okay, so can we sort of come here? Okay, so at that point, no, just a little ahead, okay, towards the peak, this point here. Let me just come here. Okay, now watch that. See, Fed fund rates in July of 27 was 5.26. And what have we explained so far? What have we learned so far? Is that when interest rates go down, everything becomes cheap, and therefore profits go up. And because profits go up, the stock market should move up, right? Now we are making a direct connection to the stock market because that is also how we are all connected together. And if you have any other questions related to that, do post it on the chat box, and we'll talk about it as soon as we're done with this subject. So now watch here what happened, okay? Fed started cutting the rates from 5.26 and downwards. Now, something very funny happened. Look at this. Actually, if things became cheap, just move slowly, just gently move ahead. See? Can you see? The blue line is, by the way, S&P 500, and the orange line is the Fed funds, okay? So now as the Fed funds are coming down, so the rate has come down from 525 to 394. Move further, please, slowly. 228. And move further. Okay, 2. And move further. 181. Move further. 097. Go on. Okay, now here, Fed funds have almost become 0.16, as you can see. Means near zero. Now what has happened is the S&P has actually fallen down completely. Now, the reverse has happened, right? Let me repeat. When interest rates go down, what has to happen is things have to prosper, because the only guy who's complaining is the fixed depositor. But everybody else is happy when the rates are going down, right? So corporate profits obviously should have gone up. And obviously what should have happened is share price would have gone up because everybody's making more money. But funnily, what happened is this sort of went away. Now, why did this happen? Now, of course, a lot of you may remember, this was actually the crash of 2008. This was the housing crash that happened in America. Okay. So now look at this. Now, this is a little complex to understand again, okay? The moment the market started crashing in January 2008 onwards, okay? So from that point onwards, there was no return, right? Everything was falling down and at a tremendous speed. But remember what happened before that in 2005 and 6 and 7, and Jyotin uncle, you will probably know this thing in America. Every Tom, Dick and Harry was getting loans because there was so much money. See, interest rates were getting reduced. Remember, we showed that 2018-19 onwards, the rates were going down. So there was a lot of money that was released in the market. Okay. And because of that release in the market, a lot of people had taken the money in their pockets. Everybody was getting loans. Some people invest in stock market. Some people, like I said, do plant and machinery. They build factories. They build real estates. And some people invest in real estate. So everybody was getting loans. Now, at some point in time, they realized, oh shit, now these loans are all really getting bad because people don't have the ability to repay. So on one side, a lot of money was there. Second side, they couldn't pay back. And obviously, the mortgage market went through a very difficult time, and then the stock market collapsed. Now, come back to that. Show me that presentation again. Show me that interest rate again. Okay, now remember that. So, although in this period we should have gone down, the market should have gone up because the interest rates went down. So, market should have technically gone up. But because of this housing crash, what happened is, but the housing crash happened because of what happened in the past. So in the past, see, everything was going up. If you see, the graph was upwards this way because everybody was happy. Everybody was making money. Real estate companies were making money. Corporate profits were high. Okay, because interest rates were what they were, but everybody had money, right? And at this point of time, when the rates actually started coming down, the market also went down. Very, very spooky, right? One would think. Okay, now let's sort of move forward. Then can you see this period where the interest rates were more or less at zero? Okay, the S&P actually started moving up. So this is where the housing crash got over, and the real effect of interest rates going down actually came in this zone. It came in this period. Okay, what does this mean? This means that whatever action the central banks take, the effect of that comes after a certain lag period. This is something that we saw, we learned. Very, very interesting stuff. Now, I'll tell you, I'll just put all the pieces together in a couple of minutes. Okay. Point number one, when rates started falling down, I'm just repeating, markets also went down. It had a different reason, but whatever be the reason, it went down. Okay. After some time, when the rate stabilized, okay, the effect of this lowering of interest rate came after some time. See, the moment the rate is down, the only person who's immediately happy is the home loan borrower, because immediately you get that benefit. But if I'm a company, if I'm a country, and we are making so much of investments into new machinery, plants, we are building manufacturing capacity, it will take some time. There will be some lag time effect, right? For actually that profit or the lower interest rate to translate into profits and therefore increase in share price, right? But immediate reaction was down. Okay. Then now move your cursor, please. So in this ensuing period, everything was steady. Markets were moving up beautifully. Okay. Now come to this point of 1819. Okay. Now here at this point of time, they had to raise rates because obviously, the market moving up means there was so much of investment happening. See that cycle which we showed you where the interest rates were first rising and then they were falling. So the same thing happened here. At some point of time, the US felt, oh, there's too much of overheating. Now let me start reducing. COVID had not struck till then. Okay. So then what happened is here, the interest rate were cut at this point. Okay. I'll just remove my notations again. Right, exactly at this point where the cursor is now. So where Fed rates were at 242 and S&P was at almost 3,000. Now here, look at this period. Okay, very interesting. This is where the Fed rate fell. Okay, and go slowly, go move forward, slowly. Okay, so while it was falling, this is perfectly what we expect in the market. The moment it is falling, okay, the market is moving up. Fed rate going down, market moving up. This is a perfect textbook activity happening. Okay, Fed rate goes further down. Now COVID has struck and all that has happened. So it went completely down and the market zoomed up. So this happened immediately. In fact, again, this was a special event, once in 100-year activity of COVID. But this is where it worked textbook. Rates down, market up. This is exactly as we expect from our economic textbook. Okay, now come here. Come here, please. Now overheating of the economy. Okay, so now this is a point where again Fed thinks, now let me start raising the rates. Okay, so now they are starting raising the rates. Okay, go further up, please. So from 0.33, can you see the rates are climbing? Okay, little more, just a little more. They are 2.5. Now they've come to 3. Now see, while all these rates are moving up, the same thing simultaneously the rate is still moving up. Okay, but now what are people remember I said that there is a lag effect, so people forget about it. The people say, okay, what the hell, the rate is 3%. No, let it go up a little more. Let it go up a little more. Chalega, we'll manage it. Borrowing is becoming a little costly. No problem. We are in a completely crazy situation where everybody's making profits. Company is doing very well. The country is doing very well. Borrowing cost is up. Doesn't matter. Let's continue. And that's why the party continued and this rally also continued. Can you see that? So now this is also funny, right? Because as the interest rates are moving up, the market should have technically, it fell a little bit, okay, but it should have fallen a lot more, which didn't happen because of lag effect. Remember? So interest rates going up, market also sort of going up. Now, I hope so far this is clear. Now look at this point. Come exactly at this point. Look at this point. Now, this is August, September 2024. This is just about a month back, okay? And you can't actually see it. Can you now click on 5 years so that we are able to see this point a little more clearly? Yeah. Now, can you see this little down move that has just happened. I'm going to say something very interesting, okay? See, remember the lag effect is playing. Now we are here standing in August 24 and move one step further, and you will come to exactly September 2024, where federal rates were down by 0.5%. Now, why is this thing so important? Okay. And think about what's happening in the world right now. Think about what's happening in the world right now. As we speak, right now, there is a war which is happening in Israel, and Israel is fighting with four fronts, with Iran, with in Palestine, Gaza. I mean, all of that is happening. We're fighting three or four different fronts. So that's the backdrop that we have. Interest rates have started coming down. The stock market should go up. But what has happened? We are today on 5th of October, and everyone knows what has happened in the last 2 days. Indian markets fell. In world markets also fell. Everybody's down. Remember what I said? There's a lag effect playing in. Now, interest rates going down, the market should go up, but it is going down. Now, what do we expect? Don't know. Maybe, just maybe, okay? None of us is an expert at this, but maybe what happens right after this is maybe this will continue. So we don't know. We absolutely have no idea what is going to happen. I mean, on Monday and Tuesday in the coming weeks. But as it appears, it seems that we are going to go through some seriously turbulent times, because this is what the history tells us. Every time rate cuts happen, okay, because we were in an overheated scenario, the lag effect might play in. So this last quarter might actually be a difficult quarter. We might actually see a little bit of I hope it's a correction. And generally, it will always be a correction, because crashes don't really happen in bull markets. So we are in a very good structural bull market. India is doing absolutely well, and the world will also start doing well. And I mean, US has started cutting down the rates as a first signal. Globally, everybody will follow. India, we have also made a statement saying that we will cut rates when we think the time is right, and from an Indian point of view. Let's come back to the presentation. So we might, friends, we might see a little bit of a fall, which might happen. Okay, let's move forward. Let's actually see what's happening around the world. Okay, we've spoken about this, and we said why we might go down. It's the lag effect which might come in. But okay, hold on. The good news, the very good news here is that there is a lag effect which will play, but in about 2, 3, 4 months it should go away. Now, what should we do? We should actually collate the money, because then the opportunity after 3 months or 6 months after this lag period is over will be fabulous. Remember, when the rates will stabilize, we will probably take off, and we will have another new huge rally that might start. Okay, globally in America, America says, these are some very, very latest, facts from America. So GDP is continuing at the same pace. Inflation is reasonable. I mean, that's why they are thinking that, let's cut down the rates. That's America. Move on. And let's look at Europe. So here also, the inflation is a little bit high, but the European Commercial Bank has also announced its first rate cut. So they are going to start cutting rates. So America, for Europe was first, America was following. I mean, there's just a little sequential thing. Someone is ahead, someone is behind. Move on. Okay, Asia, same thing. Everything's looking good. China is looking sort of yeah. I mean, Srinivas, that's right. China is also giving this rate cut effect. So China is also going to start cutting rates. India will start cutting rates, because everywhere now, India, we are in a sweet spot. We are already growing. See, the other places, economic activity is down because of overheated and inflation. Of course, also the fact that because of Russia-Ukraine war, the oil prices sort of went up, inflation went up. They had trouble. We didn't have that trouble. So we were anyways growing when the rest of the world was in trouble. Now, with the interest rates going down around the world, India's growth and trade movement will go even further. I mean, we will leapfrog. So India is in a very, very sweet spot. So if you're not invested in India, then, especially with all your friends, children, family, whoever is outside, please tell everybody that they need to have a big portfolio in India. Not a small one, but a big, significant chunk of their investment should be in India. And by the way, dollar and rupee has also been stable for a very, very long time. And with the US dollar and de-dollarization, we spoke about that in a couple of other MMF sessions. you might actually be better off having a little bit of currency outside the dollar versus the traditional thinking of having currency and assets in dollars. So there's a lot of good happening around the world. Something very interesting also sort of next happening in Japan. Japan incidentally raised the rates because Japan has its own sort of issue that is happening, and they basically had a difficult time anyways going on. So what they wanted to do is they wanted to keep in line with their inflation. So Japan is slightly different. We'll not go too deep into that, but Japan increased the rates. Okay, so money is actually a little bit of money might even flow to Japan. Money is already flowing to China. So slightly different take happening in Japan, and they are trying to do their own fixing of their own economy, and which is why they are raising rates. But the rest of the world is going to keep reducing rates as we move along. Move on, please. So coming to investment strategy, what I was saying is if the whole world is going to go down and down in terms of interest rates, and then as an inertia effect, if the markets also go down, then that becomes a very, very good opportunity for us to start building a little bit of cash corpus and get ready to, again invest in high growth stocks. What will also happen is blue chips might suddenly start doing well. If you've noticed in India, for a long time, blue chip stocks didn't do too well, right? I mean, the best of the best companies actually were flat for the last 3-4 years. Now, maybe there will be some amount of momentum happening in that area. Maybe there is a strategy to shift a little bit of blue chip. We'll come to you when we think that is a fair thing to do. Okay. On the other hand, what happens is real estate is like an immediate beneficiary, and whether it's the real estate developer, whether it is the real estate investor through REITs, and whether it is you and me as the end consumer or investor in real estate, lower borrowing cost automatically is a positive and an upward movement sign for real estate always. Okay. And for the smarter investors, which we always talk about, these things happen sometimes, not all the time. Okay. What happens is, understand one thing: when the rates go down, okay, when the ROI, the rate of interest goes down, obviously the interest that you're going to earn is going to go down. But if you're invested in bonds, then the bond value moves up. So people make capital gains, CG, in bonds. So this is a very small little window, but for a lot of people who would like to invest in government securities and gilt funds, it might actually be a very nice proposition to be in this area for about 6 months to maybe a year and a half tops, not more than that. But what happens in this period is that suddenly these gilt funds and government securities fund, they also tend to make between anywhere between 8 to 10 to about 12% kind of return. So this becomes a very short term sort of an opportunity. But this always happens when the interest rates go down. So because we are at the absolute beginning of a down cycle, so we can see this also happening. One can take a little advantage here. This, of course, is a slightly longer term activity, which is real estate and REIT investments, but something that we can all do without making any sort of speculation about whether blue chips will go up or not. I think growth stocks, which is the small cap, mid cap, will move up, and even the blue chip will move up, because like I said, we are in an extremely sweet spot. So I think India is very well placed, and we'll do very well to invest in all these strategies. So move on, please. So that's basically summary. What I wanted to say is just understand this: when rates go down, it's the signal of a good time coming in. When rates go up, obviously it's not such a good time. It's going to be a challenging time. Inflation is going to be higher. But the stock market tends to follow the interest rate movement, but with a little lag effect. That is what is the sum and substance of the session here. Interest rates go down, immediate knee-jerk reaction in the market will also go down. Not because of interest rate, but because of some other reason which is also playing in the background. The current reason is the war and the instability. So that might actually push it down. We don't know what might actually come out, what news flow will happen in the rest of October and November. But history says that with falling rates, there might be a falling market for some time, and the effect will happen with a little bit of a lag time, and then the markets will move up. So we are in for a little turbulence, but that's what it is, and that's where we are. So with that, friends, what I want to do is I want to close this presentation.